George Soros. To some, he's a financial wizard, to others, a ruthless speculator. His legendary status was cemented in 1992 when he made a reported $1 billion shorting the British pound, earning him the moniker, the man who broke the Bank of England. Born in Hungary in 1930, he experienced the horrors of Nazi occupation, instilling in him a deep understanding of political instability. He later escaped communist rule, landing in London, where he honed his financial skills. Soros's journey to becoming a financial titan is a testament to his relentless pursuit of knowledge. He developed a unique investment philosophy, diverging sharply from the efficient market hypothesis. Soros's approach, rooted in reflexivity, argues that markets are influenced by the biases and emotions of participants. This insight forms the bedrock of Soros's success. Soros's investment philosophy is often shrouded in mystery. His methods stem from a deep understanding of human psychology and market distortions. One key principle is reflexivity, where investors' perceptions influence the assets they trade. Soros believes markets are inherently unstable, driven by herd mentality. He sees these periods as opportunities to profit by anticipating shifts in sentiment. Soros is known for his willingness to hold on to positions even when they go against prevailing trends. His approach requires a high tolerance for risk and a deep understanding of global macroeconomics. Soros's investment philosophy is often described as a form of alchemy. His success is due to his intellectual prowess and market intuition, grounded in a rigorous analytical framework. He is a voracious consumer of information, constantly expanding his understanding of global events. Soros encourages dissent and debate within his team, believing the best ideas emerge from a clash of perspectives. He is a master of timing, knowing when to enter and exit trades. Soros's strategy is constantly evolving, adapting to changing market conditions. This flexibility is essential to his enduring success in global finance. At the heart of Soros's investment philosophy lies reflexivity. Markets are teeming with emotions, biases, and self-fulfilling prophecies. Investors react to each other's reactions, creating a feedback loop where perceptions influence reality. This leads to periods of boom and bust where markets swing wildly. Soros embraces market irrationality, looking for moments when the feedback loop is at its most extreme. He places his bets on what others believe will be, not just on what is. Understanding reflexivity is the foundation of his investment strategy. He doesn't fight market irrationality, he exploits it. Soros sees opportunity in chaos. Periods of instability are also periods of great potential. He compares his approach to surfing, studying market patterns and positioning himself to profit from its movements. Soros waits patiently for the right opportunity, sometimes sitting on the sidelines for extended periods. When he sees an opening, he acts decisively, making large, concentrated bets. Critics accuse him of recklessness, but Soros sees it as taking calculated risks. He believes that by understanding market chaos, he's not gambling, but making informed decisions. Soros's approach requires patience and decisiveness. Soros's willingness to short sell is often misunderstood. Shorting is betting against an asset, profiting when its price goes down. Soros sees shorting as a necessary corrective mechanism in a market prone to irrational exuberance. When he believes an asset is overvalued, he's willing to take a short position. His contrarian approach has earned him both admiration and animosity. Soros's short-selling activities are driven by his understanding of reflexivity. He's not trying to cause crashes, he's profiting from his ability to anticipate market swings. The year is 1992. Europe is abuzz with talk of unity, but Soros sees cracks in the facade. The British pound is overvalued, pegged to the German mark at an unsustainable rate. Soros begins quietly, amassing a large short position in the pound. His analysts work around the clock, gathering data and monitoring currency flows. On Black Wednesday, September 16, 1992, Soros unleashes his attack. He instructs his traders to sell pounds aggressively, flooding the market. The pound plummets, breaking through its lower limit against the German mark. The Bank of England scrambles to intervene, but it's too late. Soros walks away with a reported $1 billion profit. Fast forward to the early 2000s. The US housing market is booming, but Soros sees the warning signs. He begins shorting subprime mortgage-backed securities. Many dismiss his warnings, convinced the housing market will continue its upward trajectory. In 2007, the bubble bursts, triggering a chain reaction in the financial system. Soros profits handsomely from his short positions. His quantum fund reportedly returns 30% in 2007. Soros's ability to anticipate market shifts proves invaluable. Soros's success isn't just about picking the right assets, it's about timing those picks to perfection. He understands that markets move in cycles, driven by waves of optimism and pessimism. He compares his approach to that of a chess grandmaster, thinking several moves ahead. Soros is willing to hold onto a position for months, even years, if he believes the underlying thesis is sound. But he's also willing to cut his losses quickly when proven wrong. This ability to hold two seemingly contradictory ideas, patience and decisiveness, sets Soros apart. He operates on a different time frame, guided by his own internal compass. Soros's investment exploits often grab headlines, painting a picture of a ruthless speculator. But there's another side to Soros, a philanthropist and a champion of open societies. He's poured billions into promoting democracy, human rights, and social justice. His Open Society foundations support a wide range of initiatives worldwide. Soros sees his philanthropy as inseparable from his investment philosophy. He believes that true wealth is about making a positive impact on the world. Soros's legacy extends far beyond the realm of finance. While algorithms dominate Wall Street, Soros holds on to human intuition. He believes data tells only half the story, the other half is human emotion. Soros surrounds himself with a diverse team, encouraging debate and dissent. He seeks to understand the narratives that drive human behavior. Markets are driven by the hopes, fears, and dreams of individuals. This focus on the human element allows Soros to anticipate shifts in sentiment. He's not just reading charts, he's reading the collective mood. Soros understands that information is power, especially in the fast-paced world of finance. But he doesn't rely on publicly available data alone. He's cultivated a vast network of contacts over decades. Politicians, CEOs, academics, even former spies. These aren't just casual acquaintances. They're trusted sources who provide him with on-the-ground insights, whispers of policy shifts, and early warnings of emerging trends. This information network, invisible to most, is one of Soros's most valuable assets. He understands that the most valuable information is often not what's being said, but what's being said, the subtle cues and whispers that reveal the true story. This is where his network proves invaluable, providing him with a mosaic of perspectives that help him piece together the bigger picture. This reliance on human intelligence, rather than just artificial intelligence, gives Soros an edge in a world increasingly reliant on algorithms and data crunching. He understands that while machines are good at processing data, they still struggle to replicate the nuanced understanding of human behavior that's essential for navigating complex systems like financial markets. Every investor claims to be a contrarian, but Soros takes it to another level. He doesn't just go against the grain, looking for the flaws and inconsistencies that others miss. When everyone zigs, he doesn't automatically zag. He asks, why is everyone zigging? What are they seeing that I'm not? Or more importantly, what are they seeing? He's willing to hold positions that seem outlandish, even reckless to others, as long as his underlying analysis remains intact. This unwavering conviction, rooted in his deep understanding of reflexivity and market cycles, allows him to weather short-term volatility and capitalize on long-term trends. His contrarianism isn't about being different for the sake of it, it's about challenging conventional wisdom, questioning assumptions, and being willing to see the world differently than the crowd. It's this intellectual independence, this refusal to be swayed by the herd mentality, that allows him to identify and exploit opportunities that others miss. Here's the most intriguing contradiction. Soros, the ruthless speculator, the man who broke the bank, is also a passionate philanthropist, pouring billions into causes that promote open societies and challenge inequality. Some see this as hypocrisy, a way to atone for his aggressive investment tactics. But Soros sees it differently. He believes that a healthy society, one with strong institutions and a commitment to justice, is essential for a healthy economy. His philanthropy isn't just about giving back, it's about creating a more stable and equitable world, one where markets can function fairly and efficiently. In a sense, his philanthropy is a hedge against the very instability and inequality that his investment strategies often exploit. This holistic approach, this understanding that finance is not an isolated game but deeply intertwined with the social and political fabric of our world, is what makes Soros such a complex and fascinating figure. He's not just an investor, he's a philosopher king, a student of history, and a passionate advocate for a better future. Soros's impact on global finance is undeniable. He's rewritten the rules, forcing investors and policymakers to rethink conventional wisdom. His billion-dollar bets have moved markets, exposed vulnerabilities, and sparked debates. His shorting of the British pound reshaped the European economic landscape. Soros's impact extends beyond finance, challenging the status quo and championing open societies. Soros's outspokenness on political and social issues has earned him both admiration and animosity. He's a vocal critic of authoritarianism, a champion of human rights, and a staunch defender of liberal democracy. His Open Society foundations, active in over 100 countries, have poured billions into promoting these causes, often challenging the very governments he's invested in. This activism has made him a target of conspiracy theorists and authoritarian regimes who accuse him of meddling in sovereign affairs, manipulating markets, and promoting a globalist agenda. He's been demonized by right-wing media, accused of being the puppet master behind everything from student protests to refugee crises. But Soros remains undeterred. He sees his philanthropy as an extension of his investment philosophy, a belief that open societies with strong institutions and a commitment to justice are essential for long-term stability and prosperity. He's willing to put his money where his mouth is, challenging power structures and advocating for a more just and equitable world, even if it means becoming a target himself. Soros's legacy is complex and multifaceted. He's a study in contradictions, the ruthless speculator who champions social justice, the financial titan who warns of capitalism's excesses, the market manipulator who advocates for transparency. He's been called a hypocrite, a hero, a villain, a visionary. The truth, as always, lies somewhere in between. What's undeniable is his impact, his ability to disrupt systems, challenge assumptions, and provoke debate. He's forced us to confront the messy realities of global finance, where human emotions and political machinations collide with economic theory. He's shown us that markets are not self-regulating machines but complex ecosystems, susceptible to manipulation, prone to booms and busts, and deeply intertwined with the social and political fabric of our world. He's also reminded us that with great wealth comes great responsibility, a lesson often forgotten in the cutthroat world of finance. Whether you admire his methods or abhor them, there's no denying that George Soros has left an enduring mark on the world, a legacy that will continue to be debated and dissected for generations to come. George Soros defies easy categorization, a capitalist questioning unfettered markets, a philanthropist profiting from turmoil, an enigma wrapped in a paradox, reflecting human nature's complexities. Some see him as a modern-day Robin Hood. Others view him as a dangerous speculator. The truth is far more nuanced. Soros operates in a world of gray, where moral absolutes crumble. Markets are arenas where human aspirations collide. He anticipates the herd's next move, seeing cracks before they widen. George Soros's shadow looms large over global finance. His once radical strategies are now mainstream, adopted by hedge funds and institutional investors. Concepts like reflexivity and market bubbles are now integral to understanding markets. Soros has fostered a generation of traders who challenge assumptions. Markets are reflections of our collective hopes and fears. Whether hero or villain, Soros has altered global finance. He reminds us that markets are driven by human beings. His legacy is one of disruption and questioning. As long as markets swing between euphoria and panic, Soros's echo will reverberate.